TGIF Warriors. How you doing, Ingmar? AJ, yes, Bran, the Sacred Herb, Ryan, everyone doing okay. So Ryan and Kman are probably back today. So how are you?
We're all back and sober.
Okay. So hope everything went good yesterday. We had some follow through in cable. I'm out. I took it. I thought maybe 123. Cable outperforming. Euro thoughts, Ryan?
Euro, it was all about one number, that 105.
Okay. All
all
right.
About that number. That was
all
it.
Right.
The big historical line. And
okay.
Good to see people in the room grabbing it there as well.
All right. Nice. Glad that the guidance was there. So what after all is said and done, what was this spike in US dollar yen last night that it came back from? Anything news-wise?
There wasn't really any news. It just looked like the rug had been pulled out of the buying that we'd seen. You know, maybe that was a crescendo yesterday on those highs, and then that was it. No more end of month buying per se, at least in the European UK morning. And yeah, we had a little bit of a crap out.
Here's the rocket ship today. It sure was a tough close to like right here. So silver way outperforming on the upside. I'm curious if gold took out that wedge line that Blake had yesterday. Gold still looks, crappy.
It did briefly. We put in two patterns in play for gold and silver yesterday. Yeah, yesterday. Yeah.
So the silver's working. The gold, where's the stop on the pattern in play?
1836.
Okay, giving it some breathing room. All right.
There's a fib level down there.
Okay. All right. 1812. Yeah, you'd be getting close to some weekly moving averages. Silver looks great. There's a weekly. It's still low around the week. I don't know. Remember I said I couldn't buy silver until I saw some things happening in miners, which makes me at least think that maybe I'm late. Here was this one right here. There you go. First Majestic, which is a pretty good bellwether, and it already touched this line. What's interesting in gold is gold's at much lower levels, and we're trying to hold this 27 level. Still a negative week unless it really, I look at weeklies. I don't know. Tell me, it's Friday, so it a few days. I'm looking at monthlies too because it's near the end of the month, and on Fridays I look at, well, okay, what has it done for the week? It's still, even with this huge rally, silver's the only one that looks pretty good. I just want to point out this one thing in NASDAQ, and I don't know if it's going to mean anything. Good call on NASDAQ's having an up week. I'm wondering if people are going to want to go home long into the shutdown. So this was a major trend break on NASDAQ. I'm not a huge believer in trend lines, but this trend line from the lows in March. All right. So, and it goes back to January. Actually, it's maybe it's even October. Let me look at this. But we're getting a kiss of it right here. Let's see. Yeah, it starts in January off these two lows. And it looked like we, broke down this week, and pretty important to hide the day right here. See it? So we'll see. Could be a good scalp, just short it and see if people have the courage to stay long into this government shutdown. I heard they got a few spending bills passed. Is that allaying fears of the shutdown, or the shutdown no one's afraid of because nothing terrible ever happened during shutdowns? And like Ryan says, the country works better without the government. Anyone know?
There was a few bits and pieces. It's still looking touch and go though, isn't it? Into this weekend, it gives us a bit of gap risk, I think, over this weekend because they said they're going to work over the deals and whatever. If there's no solution, then you as I say, you've got a bit of a gap risk perhaps Sunday night. Low liquidity hours. So we've got to be careful with it. Same with the yen. There's still an intervention risk hanging over it. I think it's lessened if we're below 150 closing the week. More so if we're below 149. But Kay made the point that the yen crosses are all up, even while dollar yen's looking a bit soggier, shall we say? So yeah, there's still risks for this weekend, definitely.
And I wanted to mention, Dale, it does seem like that that there's a push to get like Speaker of the House McCarthy removed. Like that's a big, seems like a big push right now. Because he's obviously not getting the job done. And who could? I don't know. The
that's
thing
what
is
I say.
I think the government is going to shut down. Everybody's expecting it. Everybody's also expecting some sort of spending bill to be passed.
They did that
sometime, like for them to get to some sort of agreement here in the 11th hour, as they always do, right? It ain't gonna happen this time, I don't think. No. I'm pretty sure it's not gonna happen. So here's the thing, as Ryan just said, I think there is a gap risk because I think everybody just we've been through this parade or this charade or circus or whatever you want to call it. We've been through it so many times and it's the same crap every time, and everybody's just like, who cares? This is and I know I made this point over the course of the last week or two that it's this is such a big political cycle, and the divide is so much bigger than it's ever been, Dale, as you obviously know, that there is going, this could last for a while. And I think that's I don't want to say that's the black swan, but like if you think about it, everybody, you can even talk to Ryan and Kman, you can say, well, are we going to get it, is it eventually going to get fixed? And you're going to be like, yeah, of course. It's not a matter of if, it's a matter of when. Anybody's going to tell you that. Anybody and everybody. How about if that if or when is it will 2 months from now?
Yeah.
And then we have to slice off a couple percentage point off GDP. And there's social unrest. And what if there's a lot of stuff. So I mean, I don't want to go down that road, and I personally don't think that that's going to happen. But I can tell you, Republicans and Democrats, it's like a love fest right now, right, Dale?
You mean the polarization is? How about Republicans?
Oh yeah, man, these guys are tighter than ever. They should be like holding hands, skipping down the street, and singing yippity doo-dah.
There's extremes in both parties that the main body of each party cannot rein in, and that the problem is not Republicans and Democrats, it's Republicans and Republicans on this deal.
Yeah, well, I'm just gonna say that it's the divide is very large, and it's very
So what country are you moving to?
I'm going to join Steven Stelios in Greece. So that's where I'm going.
That should be a nice place when Erdogan moves in. Let me ask Kman something here. Anyway, let me ask Kman. Here's your line, buddy. Okay, and we had a throw over. Yep. Do you trade throwovers too? Like you let it do whatever it wants above it, and then you're back in the channel, and that means something, because that's what happened in the 10-year. And even have TLT did what it had to do by taking out the lows from October. And I'm not saying that this is it, but took care of all this unfinished business. Anyone who was long capitulated under this low. And I don't know what kind of candlestick this is going to end up being on the weekly. Depends what happens today. But I wouldn't be pressing the short side of bonds or notes here. What do you think?
Hey, Dale. Hey, everybody. First of all, congrats to those who caught the overstretch of the dollar. I was saying in the throne room, how pissed off I am to have been off the desk yesterday. But anyway, yeah, I don't trade throwovers, but I'm seeing this line and I'm seeing at the risk of the shutdown, and I'm seeing at the risk of a little bit of cracks appearing. Yesterday, you guys had, okay, the GDP didn't give much, but we've seen over the past couple of days, bit of those housing data starting to look a little bit more ish. The consumer spends a bit less than expected.
Things are slowing.
There's a bit of risk creeping in there. And that was my, do you remember at the start of the week, I said the rush in the dollar, and then it's perhaps going to be a fade, and it just happened a day and a half earlier than I thought it would happen. But yeah, I think it's pretty the elastic, you know, the elastic was is still relatively close to snapping, because imagine that it's a very short slowdown and they find an agreement. By the way, I think it's perhaps a much more important one now, because they've already postponed it once, when it was in March or April, so sent us to September, and now we're here. So it potentially has a bigger impact, I reckon, this one, if it lasts longer. And then
about a couple weeks.
Yeah.
What do you think that would do to the market? Huh?
Unfortunately, we won't have data in the meantime, but there's this one big domino, which is the jobs market, and we have seen yesterday again.
Right.
Those weekly jobless claims being better than expected. I'm really starting to monitor it, because if that big domino would start to falter, then I think the story for the dollar could be a bit of a reversal starting, you know.
Yeah, do we have NFP next Friday?
Well, I really don't know. If we are in shutdown, do we have the NFP next Friday? I don't know.
The answer I think is no. I don't think we're going to have BLS services. I don't think we're going to have we're going to be able to get the inflation data, if I'm not mistaken. I think all that's gone.
Yeah, that's going to be a big uncertainty. But
sorry, I was typing something.
No problem,
I just heard your guys' conversation there, so I just needed to jump in.
Yeah.
Good morning, mate.
Good morning, Kman.
So you have to trust your charts more than government statistics, more than ever.
Yeah, that's one. You know, I think there's a bit of a risk that the elastic went far enough, and we need a bit of a comeback. And you were rightfully pointing out one interesting one is going to be the cable tonight, because yesterday already I was saying over the fixing, I said this below the day before yesterday, below 121.40, there just seemed to be enough bids to absorb whatever fixing dollar buyers were throwing at the cable. And then yesterday we started to have this snapback. It's going to be important where we close the week. 123 figure 20, that's the level. The euro dollar, we broken sub 106.1020, and we went back to revisit it this morning, and it caps for now. So we're still in end of month. We still have the last fixings to come in, but now the PCE will be important in 15 minutes to know what we are going to do, perhaps post fixings also. But I'm really cautious with what I'm going to do with the dollar. If in turn, as I said, we get a very short shutdown and we would still have the numbers, and the job market holds up, then I think we may be in for a wrecking ball dollar even until the end of the year. So that's the more, let's say, more than a day view. And as far as you were asking for the yen, I think we're really in risk territory here, because it's not so much the dollar yen, but we heard those comments from the MOF, even when the dollar yen was not moving too much. Suzuki found it useful to come in and comment And now we are seeing the yen weakening, but materially versus all other currencies than the dollar. Look at the euro yen, the snapback. Look at even the sterling yen, which sterling was a bit weaker. But then look at stuff like Aussie and Kiwi and Canada yen. They're all like ramping higher. And I really think we are in danger zone for what the yen is concerned. We have to rethink a little bit the speed of dollar yen and the levels of the dollar yen. I think we have to look at the yen in a broader picture as well, and it's going. We're in risk territory for me.
Okay, I mean, much stronger, better dollar reaction than yen reaction. At least we have a wick here.
I think it's end of month. End of month is playing in there as well. You know, it's one of the biggest signals is to sell yen. So that's we will have to see what happens after the fixing today.
That's a pretty nice week in Aussie. Kind of like could put in an outside week. You know, never quite got to the wedge line. I remember Blake in our meeting telling someone, you know, the longer it doesn't break, and how sticky it's getting.
Yeah.
Kind of gave his intuition was don't be short.
And
so I'll tell you the Aussie played out really well this week. We were talking about this you know, on the morning edge and our internal shows the other day. So what happened is we were following this descending channel. We hit it to like literally to the pip today as well. We did yesterday to the bottom of the channel. The thing is, we hit the 127% extension. And one of the points that I was making this week with the ForexAnalytix traders during the Morning Edge show, which is the show that we do, you know, in about 1 hour from right now. I was telling everybody the problem with most traders, they ignore the 127% extension. It's not a big, you know, it's not something that's on most people's radar. They don't focus on that level. They don't look far enough left either. And so if you take the last impulsive move higher in the Aussie, this is the big reaction from you know, that you see here, the big like that was a month, right? That 127% extension came in right as you hit fresh lows. So you get a lot of people chasing the market lower. They got caught short literally like a day and a half ago. It squeezed off of that support and it hit that resistance overnight. We've been really focused on that all week. You could go through the analysis on ForexAnalytix all week long and just go read through you know, all those key levels, because we've posted them all. You can see you know, through here, all this is all week long. You can see where we discussed, you know, the low here at the 127% extension. But it's amazing because it's catching people off guard on both sides. You know, traders got long probably because you saw the Kiwi break out of its triangle. It actually reached its triangle initial target last night. So as you see the Kiwi break out, you're like, okay, well, the Aussie is going to follow suit, right? So Aussie just stalled at the, you know, channel resistance. And here's the thing, we have, as you know, Kman just moments ago said, we have end of month, end of quarter flows. It is expected to be yen buying, also expected to see dollar buying as well. So for that reason, I've taken off all my dollar shorts. And Ryan, Kman, you guys missed a hell of a day yesterday. It was a big day yesterday, but hopefully you guys had a good trip. And we've seen, you know, really the US dollar pull back and get to some pretty critical levels today. I think it's going to be kind of telling where we go from here. So real quick, we got about 10 minutes. Oh, and somebody asked about gold. Would that be a hedge, or would that come into you know, demand because of a government shutdown? And that's been my argument all week, right? That you buy the dip and you buy the breakdown below the breakdown here into support, because if we go into a government shutdown, people are going to want to own dollars as not conventional wisdom as that sounds. as unconventional as that sounds, and they're probably going to want to buy some gold at the same time. So you should see gold firm up. I wouldn't get too excited about it until we get back above 1885. But let me ask you guys this. And Ryan, you know, you've been awake, probably watching the Ryder Cup, watching some of this FX action, and it looks like the United States is getting absolutely destroyed on day one. Which doesn't really surprise me, believe it or not. So what do you make, not of the Ryder Cup, but what do you make of what's happening in the currency market here, end of month, end of quarter, and what's on your radar?
Yeah, it is looking like maybe the dollar bid has washed out. You know, we're going to watch the data. The data's got to show a big variation or a big change in what's expected. It's expected to follow the CPI numbers up in the headline, down in the core. If that pattern's maintained, we can probably just put it in the rearview mirror. But yeah, you know, we've had some big levels, and where there's been big levels, they've held. You know, euro dollar 105.
I was just going to point out, yeah, because you were this. I mean, this is the breakout point for the dollar, right? Like right where we're at. Like this is it.
Yeah.
Yeah.
And it's a case, you know, like you look at saying in Aussie dollar and Kiwi dollar, like, you know, you've had these breaks, you've had these moves, but then when they've hit the bigger levels, that's where they've run into trouble. So Aussie dollar got up, big strong move, can't break through 65. You know, that's where the lines come in, and then we've got that bigger level above 65, 20-ish, 40-ish. So, you know, you've got to judge a move not only by what it's done, but what it needs to do thereafter. You know, dollar yen's not out the woods. We may still have a look at the highs, but if we get another end of month run and we don't break the highs that we saw yesterday, that's going to tell you a bit of a signal that we've got maybe a bit of a top put in there, and then we have to see what happens over the weekend with the shutdown stuff and possible intervention. So, you know, it's been up, it's been down. We've had moves on both sides of the fence this week. As always, I'll look at it. Where do we close? Where do we close the week? If we close the week pretty much unchanged on where we started it, that tells you we've done with the flows. The whole week was a move on those flows, and then next week we're back to trading the fundamentals again, and who's on pause and who's got the best stroke worst economy.
Yeah, and that's the thing, huh, Kman? I mean, you know, one of the things that I've learned, especially over, like, let's say the last 10 years, and trading with all the traders that I traded with over at Gelos, and they you know, understanding from their point of view how flows used to hit the market and how it's changed so much really over the last, you know, 10 years. You know, it used to be very almost, well, it was very calculated. You could go, oh, well, here comes the fixing, here comes the flows. Obviously, banks have gotten, and dealers have gotten much smarter than that over the last, I would say, 10 years as it's become more widely known. So now you end up getting flows throughout the course of the week. There's not, you know, if orders have to get done throughout the course of the day or throughout the course of the week, it doesn't mean it's going to get done like at the end, at as soon as the clock strikes 12 type of thing. So based on your experience, Kman, do you think all the dollar buying's been done already?
We can't say that for sure, you know.
Of course.
It is a fact, and it is a fact that people across the spectrum, like asset managers, those who really would have interest in fixings and end of month and quarter rebalancing, they have been much more active lately. They're doing a lot more via algorithmic execution. Sorry. So we can't bank on those fixings like they used to be, clear cut, whatever, last day of the month, here we go, bang, the models here and there. I've seen a lot of months now, the most is done, but it's really a fluid situation, if I may say so, because I think a lot of people who have done preemptive hedging and rebalancing, some of them have been having much worse outcomes than if they waited for the last day. So I will say that the pendulum has swung a little bit, and there is still this really clear possibility, and I think we're seeing it in the yen actually today, that people are doing it in on the last day as well. Of course, the volumes concentrated on the last half hour are less than what they were before. So we have to take everything with that little bit of pinch of salt. And it could be that this month we have seen the biggest volume already done on Wednesday, you know, and as you said, we missed a big day yesterday.
Yeah, you know, and I don't want to interrupt you here, but I wanted to say one of the things that that's factoring into everybody's end of month and a quarter ideas, and this is the one thing that I think you guys need to pull away from this, you that are listening in at home to our broadcast here, is the S&P move that we've seen just since the 14th of September. That has been about a 6% decline. Now, obviously, we've recovered some of that over the course of the last couple of days, but that big of a move requires fixing and dollar buying as a result for a lot of hedges that are going off. So just keep that in mind, that aggressiveness that we've seen just in a few weeks, that's what's really driving the desire for people to be really focused on flows, because when you get this type of volatility, you get a lot of rebalancing, and it has to happen, right? So that's the thing. Now, speaking of which, Kman, I wanted to just I'll finish up with you. Just we got a couple of minutes before data. We have risk rallying right, and the S&P is rallying right back to previous support levels. What do you think here? What do you think?
The risk as such rally, it is possible and plausible if we don't get any more really bad data. But I'm kind of a little bit afraid that we are just entering the possible worst data for the US, you know. Just possible. And I can't, if the rate, okay, assuming that they would turn really bad, I have a hard time of buying equities in a downturn in the US. The thing is, we are going to get the correlation spike in equities, because when bad data means lower yields, right? And we're going to get the correlation spike, but then I would be really careful if the data really turn bad. And I would say watch that really big domino, the jobs market. If all of a sudden that would turn sour, then it's going to be a bit of an Armageddon and trade, at least in the first sessions after that would happen. But again, I'm saying, I mean, the opposite side is still there as well. We have been talking about that. If stuff does not turn sour in the US, then your dollar wrecking ball can come back after the correction that we're seeing. And that, if stuff holds up, then I think we are going to go all the way into the end of the year.
All right.
So well, I'm really thinking that we are on the verge of a decision here. Either we reverse this dollar strength, or it's going to be Armageddon into the end of the year. And the dollar is going to take, I don't know, another 5, 6, 7, 8%. I don't know.
All right. Well, hey, speaking of which, if you guys were here yesterday, now you're a little late to the party. I'll just show you real quick. If you were here yesterday, you knew that we were, getting short dollars across the board. Just let you know, those positions have been taken off about an hour and a half ago. So just, it's been a really heck of a move. But remember, end of month and a quarter, we're going to have a lot of volatility here, and we have Golden Week next week, guys. If you're out in Asia, you might be celebrating Golden Week, which is that lack of liquidity might give us more volatility, especially just less liquidity in a period where we might have a government shutdown. It's going to be a hell of a week this next week. And speaking of which, whoops, that's not what I wanted to do. I'm going to pull the dollar over to the left. I meant to do the over here to the right. We're going to pull up yields, make sure we got our 5-minute chart or 15-minute chart, 15-minute chart, 15-minute chart. Okay, so you got the S&P in the middle, dollar index over here. We got Canadian GDP. We have PCE. What else do we have on the docket today? Ryan, anything else? Trades balanced?
We've got the Chicago PMI, the final Michigan later on as well. So, yeah. bits and
Always a
pieces.
fun day. Always a fun Friday, right?
Yep, very much so.
And we got
And
the
golf's
Ryder
on. And the golf's on, and you lot are losing. This day can't get much better.
All right, guys. Heads up. Canadian GDP came in a little worse than expected month over month. The dollar's under a little
In line, PCE, both measures in line.
All right. So here's the question: do you start buying dollars now, knowing that we're going into month end, so month and quarter end? So the PCE came in a little stronger than expected month over month. The dollar did come under pressure. I think you probably use that as an opportunity to sell euros above 106. I mean, euros at 106.05 right now. I haven't sold it, but I'm just saying I think you use that as an opportunity.
Well, be careful, because you need to know there's 3.75 billion rolling off at 106 today in the options, and it's not surprised that we're just gyrating 10 pips plus minus it for the last couple of hours.
Well, Ryan, how did you know? Oh, you have it right here, and all the expirations right here on our page, right?
Yep, and I've even put it in red for you.
Oh, wow. Look at that. Okay, it is. Man, that's a lot rolling off there. All right, well, worth noting. That's important. And I just want to say, Kman, Ryan, I really, really missed you guys yesterday. I know Dale did too. And then we were stuck with Grega for like a while, which, you guys don't leave us like that. It's not cool.
I'd like to say the feeling's mutual, but we were tucking into Bloomberg's hospitality, so no.
Oh man, did they feed you guys drinks?
Oh yeah, they watered us and fed us. Yeah.
Oh man, that's some great stuff. Awesome. Well, Kman, Ryan, jokes aside, we really did miss you guys. Nice to have you back.
Yes.
And I was just gonna say, any last minute thoughts before we hand it over to Dale with Pedro da Costa coming up?
I think be careful what the reaction, if we get this last fixing dash run for the line. Be careful what we where we go right after the 4 p.m. London clock. I think if it's really dollar buying, looking at the reaction we had yesterday, I think there's going to be some people on the other side of.
There's going to be, definitely some two-way pricing. Look at the euro just failing above 106. Wow.
And watch your trades into this weekend. If you've got yen exposure, dollar exposure, think about the risks of the shutdown and whatnot. You can take profit and you can always get back in next week.
Yeah, that's there's going to be a lot of risk, and especially with the shutdown gaps, it's going to be something. So, hey, everybody, thanks for tuning in. But make sure you all stick around, because Dale is starting right now with Mr. Pedro da Costa. So, there you go, Dale.
Thanks, Blake. Thanks, team. Thanks for everything you did this week. Have a great weekend. Hi, Pedro.
Cheers,
welcome
Hey,
back.
Dale. Thank you. Hi, everybody. Thanks for having me.
Hi, Pedro. I'm gonna check out. I just want to say hello and give you a big wave.
Thanks, Blake.
All right, Pedro. So why don't we start off with what the U.S. is facing right now, and it's a government shutdown. Your view. What do you think would happen if it lasted a few weeks?
Well, what is there to say about the U.S.? The U.S. political outlook.
Yeah, I know.
It's such a complete mess, and I think it's only going to contribute to the erosion in the faith and credit of the United States. And I think Moody's is right to say that this is a credit negative event. And I think that even though we know that every time that there's an event like this, the people pile into treasuries because it's the risk-free asset, I think over time there is an erosion that we need to keep in mind, and we don't know when that breaking point is, but we sure seem to want to keep pushing things that way. I think we could have a significant economic impact in many different ways, right? We could have a sharp slowdown in economic activity. We could have a Federal Reserve that perhaps doesn't have enough data to make a decision, and maybe punts on a rate hike when it might otherwise have hiked because it doesn't have enough data. So there's a
Okay.
lot of implications, I think.
All right. So I'm looking at the yield chart, and it felt like the 10-year really reached a crescendo up here. And we're now back inside the channel. This is kind of a blow off, and I know you're talking about people might be buying bonds and notes in here. Actually, the TLT, Pedro, finally took out the October low,
Yeah.
and I don't know who would still be long now. I'd say that we're at least in a capitulation phase. Could it be that the government shut down, and now we're not going to get an NFP next Friday if the market is shut down? You know, what are people going to do as far as trading? Just trust your charts, right? How else do you trade if we're not going to have government data?
Absolutely. I don't think that people are going to suddenly be, basing their trades off of flash PMIs, right?
Yeah.
You
Yeah.
mentioned the 10-year. This run in 10-year yields has been pretty stunning, and I think it's very deeply related to the Fed and the Fed and the market absorbing the Fed's higher for longer message in a way that it had not before. And also, I think it's like the market interpreting the Fed's shift in stance. I think it goes beyond higher for longer in a narrow sense, in the sense of like, they're going to keep rates at peak levels for a year and a half. I think it has more to do with the longer we are in this higher inflation and rate regime, the longer people think it's more of a permanent feature of our economy and less of a temporary or transitory blip, if you will. And I think markets are adjusting to that.
And this hasn't helped, has it?
No, that absolutely has not helped.
Yeah.
And
So I know people are complaining about gas prices now. I'm hearing it everywhere. People are paying $6 a gallon here in California. I know that's nothing compared to Europe, but for Americans, that's near all-time highs, even though crude is way off all-time highs.
I can't believe it's already at 6 in California. It's still around 4 in DC, but it's definitely up, and there's no sign of immediate relief. So,
okay. I talked to Lakshman Akuting this week, and he said he gets aggravated paying $5 for a cup of coffee. It stopped going up, but still can't get used to $5 for just a few beans and water.
I agree. I make my own at home, to be honest, because when I go out, it's a lot of sticker shock.
So everyone's feeling it. I don't care, what part, except maybe the 1%. They don't care. It's like they have a printing press too.
And to your point, not only is everybody feeling it, I think the idea that inflation expectations are still contained is kind of fanciful, right? Because
you're right.
Whose inflation expectations? Like, don't me and you and Lakshman, who's a good friend, by the way, we all expect to pay. We all expect to pay more when we go to a restaurant after a couple of months, right?
Right.
So whose expectations are contained? I'm not quite sure.
Yeah. And I mean, the housing, a friend of mine who's, worked hard all his life, and he's in a position where he has to find a place to move, that people in Phoenix, Arizona, where there's no shortage of sand, are charging $1,200-$1,300 for a room in a house.
Wow.
Now, how do people?
Wait a second. I live in here in the Phoenix area. So
what would you rent a bedroom out for?
For a bedroom?
Yeah, a room in your house. People are doing it all over the place. They
definitely you could. Yeah, I think that's exactly what you could charge for it. There's I live in the Scottsdale area, so in our popular area of Scottsdale right here, it for a 1-bedroom apartment is $2,500. 1-bedroom apartment. So that makes sense.
So how does someone who's making 50, maybe has a wife and kid, afford it? I mean, it's I think there's a lot of people feel like, what happened to the world where even I, through most of my life, have been able to keep a roof over my head and take care of myself and people I love. are unable to do so because of these prices. And nothing could really be done about it anyway, unless we have, it's almost like we need a major depression, Pedro, to, shake things down and start over.
And yet that's not going to help anybody at the bottom end of the ladder either, right? So
Yeah. So
I'm not quite sure what the solution is for ameliorating
the housing.
that.
Yeah. I don't know why they just have BlackRock cough up all the properties they bought in the last 10 years that they're renting back to people who were foreclosed upon.
Well, I was going to say, taking this sort of major investor money out of the housing market and treating it less like a volatile financial asset would help, certainly.
Yeah. Any view on what's happening in Japan? A few of our guys think we're real close to intervention taking place. And do you think that the Fed might cooperate with the BOJ?
I don't think so.
Okay.
I don't think there's any prospect for cooperation. I don't have any direct insight, but from what I read from our very well-informed Japanese colleagues, intervention is a strong possibility. They're running a monetary policy that's not in concert with their desires for the currency. So there's an inherent conflict there.
Okay. Dollar, they say that Forex is a great trending instrument. Look at this, Pedro. 13 weeks, all blue candles, relentless. You think we could be peaking out here at least temporarily? I was kind of thinking maybe we get a shake to 104 and then go again.
I don't know, man. I'm loath to make Forex predictions because you guys are better at that than me. But I mean, the way I look at it, I don't think, at least from the patch that I pay attention to and cover, I don't see the sort of Fed hawkishness and economic bullishness that we've had versus our peers. I don't see that differential kind of narrowing anytime soon. So I'm not really sure.
So we're still the best sturdy shirt on the globe.
You got it.
Okay, so what was your thought about the Italy's 40% windfall profit tax, which here in the U.S. mainly happened to oil companies, that they issued against banks in Italy? Their windfall profit. I didn't even know they had profits in Italy.
I don't have any deep thoughts on the Italian situation other than, it seems like a natural kind of populist reaction from a government that is very, I guess calling them populist is a nice way to put it. And I think they're already backtracking on it to some extent, right after a very adverse market reaction. So I'm not sure if it's actually going to be as large as it was first advertised.
Is the bearishness in China warranted?
I think it is. I mean, it seems like they have more problems than they have solutions for. And it seems like they lack the policy tools to address imbalances that have been building over, years and years. So my big thing is the Fed seems to be very sanguine about the disconnectedness of the US economy from China and from the Chinese financial system in particular. And I wonder if there aren't more linkages and connections that might sort of come to pass that we have not thought of. Given the sort of global nature of the investing universe.
Yeah. So do you think it'll be overt, or it's just like kind of a black swan kind of thing? Because it was pretty overt when they stopped using Apple phones, government officials. What are you thinking? I hear that they're trying to thaw relations with us, and that the big month for China US is going to be the Taiwanese elections in January. That if there's another pro-independence president, that would be kind of like the last nail in the coffin, that they were going to have to consider a hostile takeover.
Yeah, I mean, I don't see relations thawing anytime soon, and it certainly sounds like if there's actually if you look for one point of rare bipartisanship in Washington, it's both parties' kind of vilification of China and
Yeah, that's
use of
true.
China as a kind of foreign enemy cudgel, and so I don't see that waning anytime soon. If anything, President Biden has extended the policies that Donald Trump put into place. So I don't see that coming anytime soon.
Could you imagine that we could have a presidential campaign with one of the candidates being impeached and another one on trial?
It goes back to my original comment about the state of U.S. politics, right?
Yeah, Rod Serling couldn't have written a script like that.
Exactly. It's pretty ridiculous and pathetic. And I'm glad that in my youth, I thought that covering politics was all the rage before I got into finance. And I'm glad that I'm writing about finance and not politics, because it's ridiculous to the point of being boring,
Yeah, it's over and over.
There's no substance to it. It's just trash. So.
Okay. So, we've had, I don't know who you're talking to, but we had this risk off move after the Fed. Wasn't what the Fed did, it's what the market did after the Fed.
Yeah.
Is this a beginning? Do you think from the people you're talking to, the bulls are coming back in, just calling this a normal corrective decline, and that even in the face of government shutdown, that it's clear sailing for equity markets from here?
Yeah, I'm not so sure about the clear sailing. I think we are at an inflection point. I think things are getting dicier, and I think the fourth quarter might be a memorable one. So,
okay.
Yeah, I think that the Fed is not going to relent as easily as markets believe. I recently spoke to Steve Kman, a former Fed board economist, who's now at the American Enterprise Institute. And his take was that despite sort of chatter that the risks of over tightening are becoming more balanced with the risks of under tightening, he said that from a purely kind of legacy perspective for Jay Powell, he called the risks, quote, wildly asymmetric, in the sense that if you take door A, which is the over tightening door, you maybe cause a recession that everybody kind of expected anyway, and you go home with the legacy of having fought inflation. If you take door B, you risk, an inflation that like tarnishes your legacy and makes you the modern day Arthur Burns. And as he put it, that's the last thing that Jay Powell wants. So his path of least resistance is still to remain as hawkish as possible.
Okay. Markets have been ignoring his message for a long time. 10 years still coming off today. Anything that you're getting ready to cover, have covered recently, that you want to share with us today, that perhaps with my wandering questions that I've brought to you, that you think it's important for people to keep an eye on, Pedro?
Sure, a couple things. Well, the first thing that comes to mind is I was very baffled by the Chair Powell's answer to the question as to whether the soft landing had become his baseline scenario, because he clearly answered no. He was very nervous to put his approval stamp on a soft landing, if you will. And yet, if you look at the S&P, the Fed's forecasts are for a soft landing, right? They expect inflation to come back down to target without unemployment going much above 4%. That's basically the definition of a soft landing. So there's a disconnect there that I think they're going to have to adjust. Another point I would mention is Claudia Sahm, former Fed board economist. I spoke with her last week. She made a really important point that the Fed is using the S&P as a forward guidance tool, but it's a highly imperfect one, even more imperfect and more imprecise than interest rates, because you've got these uncoordinated forecasts that come together to form a median, And she said they really are not coordinated. And she was one of the forecasters there, so she would know. And so you're trying to send this signal, but you're sending a signal that comes from all these disparate signals. And so to her point, what they wanted to do was pause. What they actually did was hike interest rates by repricing the entire curve. So I thought that was an interesting disconnect there. And the third thing that I would bring up that's on my radar that keeps coming up both from market participants and from sort of Fed watchers is this notion of an inflation target and what it actually is.
Yes.
If you look at the Fed's tolerance for above 2% inflation, they don't see inflation getting down to 2% until 2026. So that's pretty, that's a long period of above target inflation, which suggests that you're okay with overshooting the target for a while. And you keep in mind that the Fed is going to begin its review of the framework that was much maligned in the ones that they switched in 2020 to make it sort of more dovish and more pro-employment. They're going to be reviewing that, and the review will end in 2025, but it really begins in earnest next year. And there's a lot of indications that they might move toward something like a target band that's less precise and perhaps more achievable, something like 1.5 to 2.5. But again, that has big implications for markets, and I think that possibility and that idea is part of what's underpinning this move higher in 10-year yields.
Okay, buddy. Well, I'm showing your site and where your work appears, and
I appreciate it.
people,
If you go to the policy tab, and then you see the Fed policy exclusives there. If you click on Fed, that's where all of our content is right there. Just stay on policy. It's a little funky, but just go down and there you go.
all right, there you go. So here's Pedro's writings, and it's kind of the Fed. It's hard for me to understand. I wanted to wrap it with this question. Do you think there's a possibility of some type of liquidity crisis?
I do.
Okay, because I know some people that are pretty conservative have said that. And I mean, Joseph Wang isn't exactly, someone who is, seeking, to shake people up. And I think he's written about a potential liquidity crisis. How would that evolve?
I agree.
And
I take his warnings very seriously. And I think actually that the spike in 10-year yields is not, it might be an inkling of what's happening there, right?
I see. Okay, so crowding out, and just is it because of all the supply?
It's a real confluence of factors that's kind of a nightmare scenario. You've got a huge amount of supply and a large amount of concern about who the potential buyers are. All these captive buyers that used to exist are now gone. So the Fed was number one, and the Fed is now winding down its balance sheet. Japan and China are two others, and for reasons we've already discussed, they might become less keen as buyers. Yeah. So that leaves kind of domestic investors
or the Fed. Do you think the Fed?
But the Fed would have to intervene, right? And they would, of course, they would. If there was a Treasury market meltdown, they definitely would intervene. But then they would be reversing some of their tightening, and then we'd start the whole party all over again. So I'm not sure how it's going to play out, but I take Joseph's warnings very seriously, and he's not the only one that's concerned about it. I think even people at the Fed, I mean, it surprised me when I spoke to Jeremy Stein, who's a former Fed board governor, who's very in tune with this finance stuff. He's on the Financial Stability Board, all kinds of advisory boards on this stuff. And he basically said to me that, even if you implemented all of the solutions that he and folks like Daryl Duffy have outlined, the market would still be prone to liquidity shocks just because of its structure and size. So that's not very reassuring that even the reform-minded people who have a list of reforms that they think would help, even they don't think that it's kind of a completely soluble problem.
Yeah, so it's more of question. It's not if, it's just when, which is the art of this whole thing, the when.
It really seems that way. Yeah.
All right. Well, great conversation, Pedro. Again,
thank you, Dale. My pleasure.
I told people I look forward to talking to Pedro because I can ask him everything. And
I may or may not have the answer, but I try my best.
All right. Well,
Hey Dale, can I just jump in here really quick? And I just want to say, Pedro, we sure do miss
Just
you
did.
inside. Yeah, I know. Sorry, I just wanted to say sorry, Dale. I just want to
Don't
say
ask if you
we miss you in the room asking questions to Fed chair. I miss seeing your face.
Yeah, you know, I'm kind of playing a strategic game there where I don't often get a question if I go in these days. And so I just send my colleagues in and we play it that way.
That's
They're
good.
more likely to get a question than me. So I figure we maximize MNI's chances of getting a question.
Yeah.
And so just so everybody knows and understands your expertise. I mean, you've been in the room with Fed chairs for how many years now? I mean, it's been
Almost 20.
Yeah, I was gonna say I've seen your face for a couple decades now. So that's the kind of experience that you bring. And so when Dale's asking you these questions, people that are listening into this, whether they're catching us on Spotify or they're catching us, live here, is that they really should understand your expertise and your experience in this industry. So anyway, thank you for being here. Really,
and they avoid Pedro because he doesn't throw softball questions up there.
I learned the hard way that hard questions might be good for you, might get you Twitter kudos, but they're not really good for your professional longevity. So
yeah, you're always better being an ambassador.
Absolutely.
Right.
And if I could throw in a humble brag, Blake, I appreciate that comment. And actually, I've been told by Fed board staffers who are involved in the communication side that it was my reporting pointing at holes and lack of Fed transparency back in my Reuters days that actually led Bernanke to want to create a press conference in the first place. So,
I'm gonna say without prejudice, I love that shit. That's awesome. All
right. Well, thank you, Pedro, so much. I'll get a hold of you and we'll get back together in the winter.
Sounds good, guys.
Thank you. We'll hope it's not an economic winter and just a seasonal one.
Absolutely.
All right, buddy. Pedro DaCosta, follow Pedro. Go to his site at MNI and follow him on Twitter at P DaCosta. Thank you, Pedro. Have a great weekend, buddy.
Thank you, Dale. All the best,
All right.
everyone.
Thank you. And everyone, thank you. Have a great weekend. Don't just count your pips, count your blessings and do your work and be ready with your plan before the markets open. And the team and I will see you next week. Adios. You're welcome, everyone.